Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE FinWiz, powered by CNBC TV 18 Season 3. Today we are at the Mumbai head office of one of India's leading paint manufacturing companies, Kansai Nerolac Paints. Kansai Nerolac Paints is the leader in industrial coatings and is one of the largest paint companies in India with a significant presence in Sri Lanka and Nepal. The paint giant manufactures a diversified range of products ranging from decorative paint coatings for homes, offices, hospitals and hotels to sophisticated and high-performance industrial coatings. NSE FinWiz visited the office of Kansai Nerolac in Mumbai with the country's finest experts to advise and educate the young employees on investments and financial planning. Well, we are now joined by our two very special experts. We have Harshwardhan Roongta, who's a CFP with Roongta Securities. Welcome to the show, Harsh. And we have Feroze Azeez, who's the Deputy CEO with Anand Rathi Financial Services. Welcome to the show, Feroze. And our core topic for today is equities. So, Feroze, it's not the very best time to talk about equities. The markets are down and everybody is worried. And if you talk to anybody about equities, it's like, no, we don't want to touch it with a long barge pole also. So, is that a good thought at the moment that if the markets are down, then I definitely shouldn't be looking at equities also? Is that correct?
See, the answer is no. Depends on what kind of individual are you. If you're a trader, which most of them are not, right? You have a job to do, you don't have so much time that you do research and start trading in stocks. If you're an investor, then the context is very different. And if you're an investor, these become the best times to actually invest. For example, let's assume you want to actually buy winter clothing. And if there's a sale in the mall, would you actually be motivated to go buy it? Or would you be demotivated? Of course, everybody waits for a sale. If the same thing, if I want to own a stock and that's at a reasonably lower price than what it was yesterday, isn't that relatively a better time to buy? Now, putting some data on it, if you actually went back in time 10 years, pulled up all the scariest newspapers, Black Mondays, Black Fridays, take all those newspapers and say those are the dates when I would invest, where everybody else is scared, you would make twice more money than the average return which equity gives you. So coming back to your point, Sumit, so when the markets are down, actually it is time to be more vigilant, of course, but be more conscious of actually adding to your equities rather than subtracting them.
And as Warren Buffett says, you should be greedy when everyone else is fearful and fearful when everyone else is greedy. So Harsh, then definitely it's a good time to get into equities. But here's another thing, there's another view also that says, alright, should I wait for the markets to fall and only then get into equities? Or, when the markets are high, as if they're on cocaine or something and the markets are so high, definitely don't touch it then. Is that also then, because that's kind of like timing the market. So is that something to be done also?
Well, Sumit, the biggest question is, can you time the market? Is the biggest question. The idea is, do you know when is the bottom of the market or when is the top of the market? So the whole idea is, if you're unable to do that, and then you try and pursue that objective of timing the market, you're definitely going to go wrong. What happens in a market, there is no limit to how much it can go up and how much can go down. The idea is, if you picked up a business, suppose you looked at investing into equities, then you identify certain stocks if you want to invest directly into equities. So there are several methods which you can use to decide whether you want to select a sector and then pick up a particular stock in that sector. Or you look at certain companies whose functioning you understand and then look at how the impact of that company in the sector and the economy. The question is, current times when we've seen the market correct so much, we've seen a generally not so favorable circumstances to invest. And as you said, what Warren Buffett says, when be fearful when others are greedy and be greedy when others are fearful. If you find a company which you anyways wanted to invest into at a price which is lesser than what it was a few months ago, why would you not buy it? So the whole exercise of timing the market, I think it's just a figment of imagination that you can do it and it can be done. I don't think anybody can time the market. The whole idea is you're owning assets. Look at it from that perspective. You're going to own a particular company. You're going to become a shareholder. You're going to become a partner of a particular company. All companies go through the bad phases and good phases. So if this is a good time to buy, you should definitely.
Okay. Harsh, there's this question from Akriti Sinha. She says, does a high PE ratio indicate a good stock?
Oh, well, so there are two kinds of, companies which are listed. There is one, an industry PE. Okay, so when we say a pharma industry, PE would be X. So generally, all the companies in the pharma sector would be trading around that PE. Obviously, you would have some winners within that sector itself because the prospects of future look very promising. So somebody might be willing to pay that premium for that future growth. Now, this is the sector PE that I spoke about. Then there is an indices PE. What is the Sensex or the Nifty trading at? Okay, so then there's a trailing and there's a forward PE. Now, so the index PE would give you a general outlook about the prices as compared to the underlying profits. Then we spoke about the sector PE. Now you talk about whether a higher PE indicates a better performance. Not necessarily. Why? Because you're talking about, like for instance, FMCG sector generally commands a very high PE multiple. When compared to financials would be say probably a 20 and FMCG would be 40. But does it mean that you should invest into FMCG companies? It does not mean that. It is just an indication of what a sector, what is the multiple in that particular sector for giving you a guidance, whether it is fairly priced, it is underpriced, or it is overpriced. At the same time, there are certain companies within those sectors which are priced at possibly, if I'm saying FMCG sector is 40 PE multiple, you would have some companies out of them which could even be 80 PE. It does not mean that company is much better to invest into if you do not have that kind of. So P multiple gives you an outlook, should not enable you to choose whether one company is better over the other.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. Today we're at the Mumbai head office of Kansai Nerolac Paints. Feroze, when we talk about asset allocation, how can we make it simple because the idea is every asset class is important at a certain point and has important functions, all about not putting all your eggs in one basket. So when we talk about asset allocation, can you simplify it for us, and how should a layman investor keep that in mind when going about with their personal finance?
Assets are those instruments where I put money and expect to get back something at the end. If I don't expect anything back, it is an expense, right? If I put something and wait for it to give me back something, it is an asset, correct? So if I buy myself a pair of shoes, it's not an asset because I don't expect it to remunerate me again, right? So anything where you put money and have some expectation from it, it is an asset. So firstly, what are the number of assets I have in the universe? And try and discard. The method of discarding is the best method of investing to start with. Now, like we were saying, there are 16 types of mutual funds, in which every company has 3. So there are 1,500 mutual funds. So you are better off discarding, saying that this is distraction, this is the core. Similarly, in assets, one is equity, one is debt, one is real estate, one is precious metal. Okay? There is something called commodities. So these are the 5 most prominent assets. I can buy a commodity and expect to earn from it. I can buy a precious metal like gold and expect to earn from it. So you understood how do you define an asset? Anything which I put money and expect to get back something is an asset. So these are the 5 prominent assets. If anybody is starting his financial career in the form of investing, he should discard commodities. He should discard precious metal, in my opinion. And of course, real estate, from an investing standpoint, he should discard. Because buying real estate for consumption is a different matter. Now coming to, you're left with only 2 assets, equity and debt. Okay, I personally think if your goals are very far, okay, depending on what what stage of your life you are, irrespective, between 40 to 60-70% could be into equity.
What is IPO and what are the checkpoint to invest in IPO?
The meaning of an IPO, the full form of an IPO is an initial public offering. So as the word suggests, it's an initial offering made to the public to invest into the company's equity. So say for example, a company has been into industry for say 5 years, 10 years or maybe 20 years. And the company has certain plans to expand. So they need money for capacity expansion. So what are the means to expand, to raise capital? One could be in the form of a loan which they go to banks, or they say, why not we dilute the equity, which means we will ask the people to invest into the company and we will make an offering to them. And the first offering would be an initial public offering. So that's an IPO. The objective of that IPO in this particular example is that the company is raising fresh money for capacity expansion or for whatever the objective may be. The other way why an IPO has been given is that if there is an existing promoter and they feel that I need to encash some part of my holding. We do not need the money in the company for expansion, but I need to encash. So he offers his portion of equity in the form of an IPO to the public at large. Okay, so that becomes an offer for sale through an IPO. Now the third element is our company is already listed. Okay, the initial public offering has been made, but the company wishes to raise more capital. So then they come out with a follow-on public offer. There's an FPO, wherein the company already listed on the exchange proposes to raise additional capital or dilute the capital of the promoter. So these days you would see that lots of many public sector enterprises are coming with FPOs. This is nothing but the government wanting to offload its stake to the public. Buying or investing into an IPO, the parameters would be the same as choosing which company to invest in a listed company. If a company is listed, what are the parameters you would decide to pick or invest into that company? The same parameters would apply if you have to subscribe for an IPO for any company for that matter. So you need to see the future prospects, the management, you need to see what the profitability has been, what market share does it demand in its own area of operation. So there are those factors remain the same.
On that note, it's time for a short break. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3.
When we say about the investment, it's always about short term and long term. But I feel there is always interim sizable requirements which comes into our life. If you buy a car, your foreign tours, or maybe your child education. So how to cater this requirement through mutual fund or equities? Because it always is long term is more beneficial than how to cater this in between requirements through it.
See, the interim requirements can range between 2 to 6 years, right? 2 to 6 years, 7 years and stuff. But if it is anywhere above 2 years, at least looking at the current situation, in my opinion, at least 50 to 60% can be in equity. What happens is in India, because the interest rates are very high, even if the market is bad, your 50% of debt and 50% of equity will always protect your capital over a 2-3 year time frames. So to answer your question, you can use equities as long as you have more than 1.5-2 years also, but have 50% of that goal being put into equity and 50% in debt. If it is less than 1 year, then you should only look at debt. Or 1.5 years, you should only look at debt. If it's anything more than that, you can mix it in 50-50 proportions. If it's a retirement goal, for example, on the other end of the spectrum, then you can go 80-90% into equity.
Harsh, we're coming close to the end of the financial year. This is the time when everyone, the HR, the payroll, everyone's like tax saving, declare this, that, and all of the tax deduction comes into play. How important is tax saving, and rather, how do you correctly plan that part of personal finance? What's the advice?
There is certainty about two things. It's only death and taxation. So the whole idea is, there is a share in your income which needs to go to the nation for nation building, for security, for infrastructure development, whatsoever. The idea is the government gives you certain avenues to help you reduce that tax liability. Now, you would really not be, you'd be foolish if I may say that you would not want to use those avenues available wherein you can reduce your tax liabilities. So at the beginning of the financial year itself, okay, you could make certain assessment of what are the provisions available under the Income Tax Act which help you reduce your tax liability. If you know that you're going to earn for the next 1 year, I mean, nobody is going to plan or think that they're not going to work till the end of the financial year. So you know you're going to be employed in some form or the other and you're going to generate an income. On the other hand, you have certainty saying that there are certain provisions under the Income Tax Act under which you can invest and save tax. So when both parameters are certain, why would you start planning in the month of April itself? Now, once you start in April, you have lot of time before you wherein you can decide what you want to invest for. So now coming back to your goals, coming back to what you had planned otherwise. Now if you want to save for retirement, for example, and your retirement is 25 or 30 years hence from now, so you know very clearly that you need to invest into an asset class which is equity.
Right.
Now if you need to invest into equities for long-term benefits, do you have any product which also gives you tax benefits and helps you save for 25 years in an equity fund? Yes, there is a product which is available, which is the equity linked saving schemes or the tax saving mutual fund schemes which are available. Then the question arises that if I wish to invest for long term into equity schemes, then I should start investing in equity ELSS schemes right away, because it helps me save for retirement, at the same time it helps me save tax. The third element that comes into play because you started in April is that you do not need to make a lump sum investment at one point in time. So you come back in March and then you realize I need to save tax and you need to save 1.5 lakh rupees as tax. So what do? You pick up 1.5 lakh rupees and you invest into an ELSS fund, which is an equity fund. Now hypothetically, investing as a lump sum in an equity market may not be the most sensible thing to do. So if you started early, you could plan it out and space out this 1.5 lakhs over a 12-month period. So taxation, there are avenues which you should save and you must make you should take full utilization of the benefits available and you should start early. Then only will you be able to map your goals with the investment product that you're going to choose to invest.
I do not follow stock exchange so much. Right? What could be the top 5 factors that define the way I should, or those 5 factors which I as an individual, not having a very high acumen of stock market, look forward for? Like, maybe it could be cash flow or could be something else.
See, first is, once you have decided you have to invest in equity, you need to choose a vehicle. Okay, why should I identify when there is a person who can do it for me? See, I don't drive if I can actually hire a driver, right? In the US, it might be really expensive. I might end up spending 50 lakhs a year to hire a driver. If it is $1.5 lakh in India, then I would rather hire him. So the point I'm trying to make is, there are 6,000 listed stocks. Why should I identify? The person whom we are speaking about, like Warren Buffett or anybody who is a finance professional, his job is to do that, but not yours. So you should not waste time to identify. You'd rather outsource it. He will create a basket. A mutual fund is the best vehicle for a person to do it one time, because then you have 2 levels of professional management. So the risks get mitigated significantly, is the point being made. Having said which, if you are hell-bent on identifying a stock, then there are 3-4 parameters you need to look at. And if you really are interested in actually being tangibly owning that company, then you need to look at its profitability, its future profitability expectation, read about the management, read about the business they are in, and imagine whether you will want to do a business like that if you had the capital, right? If you had all the capital, would you actually do the paint business? Then you buy that business, is the point being made. So people look at 3-4 parameters, PE ratios, look at earnings growth estimates, they look at analysts. There are several analysts who give an opinion saying that what will be the earnings in the future, because that's a humongous task to extrapolate future earnings of a company, right? Because there's so many small bits and pieces come together to add the profits or losses of the company. So identifying those small pieces is an analyst's job. So you take secondary information rather than doing that bit also.
On that note, thank you so much, Harsh. Thank you so much, Feroze. Thank you so much for having us here.
It was an extremely informative and knowledgeable session that I just had with the team. And for a layman like me, who has never had any financial exposure, it has been extremely informative.
I think it was very informative. So we have a really young workforce here, and we all have a lot of questions. You know, you want to buy a new camera, you want to go on a vacation, and amongst all of that, you have to also invest. So how do you invest? So I think that answered the question very well.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But before we go, here's a chance for you to win a cool goodie bag by answering this viewer question. Of the following fund types, which one is associated with a high risk and high return potential? Balanced fund, gilt fund, equity growth fund. Send in your answers at fwq@network18online.com. The correct answer to last week's viewer question is option A, true. Many thanks to all the viewers who sent in their replies. The winner to episode 16's viewer question is Utsab Sardar. We'll see you next week with another set of young employees at another company. Until then, from the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.